Welcome to this Asia Global Dialogue 2022 session on deglobalization debunked, decoupling or recoupling, shaping a new globalization. In recent years, what with the stalling of the World Trade Organization, the US-China trade war, and decoupling measures across a number of sectors, the weaponization of the financial system, the use of sanctions, restrictions, and exclusions as geopolitical punishment, the geotechnological competition recently manifested by US restrictions on exports to China of advanced semiconductors and chip making equipment, the emergence of Indo-Pacific nomenclature and the Indo-Pacific arrangements, such as the Quad, AUKUS, and the US devised Indo-Pacific Economic Framework, the BRI, the Belt and Road Initiative, the casting of 21st century geopolitics as a struggle between autocracies and democracies, reshoring, friendshoring, delisting, cleavages over the Ukraine war and the sanctions on Russia. I could go on about this narrative that seems to be that countries need to divide or want to divide into teams, that there is a US-China cleavage somehow, and countries in the middle somehow have to choose sides. It's fueled this deglobalization narrative, call it what you will, the search for resilience, the need for diversification. In any case, we're going to discuss this and more with a great panel assembled. And let me just very briefly introduce them in the reverse order in which they will begin to speak to give their initial views. So joining us from Norfolk, Virginia, is Fred Bergsten, non-resident senior fellow and director emeritus at the Peterson Institute for International Economics. And indeed, he chaired the APEC Eminent Persons Group from 1993 to 1995, I believe. Then we have Andrés Velasco, the Dean of the School of Public Policy at the London School of Economics and Political Science, who served as Finance Minister of Chile from 2006 to 2010, the first government of Michelle Bachelet. And I remember him from high school as the best soccer football player the school ever had, I think. Then we have James Falk, who's author of the fantastic book, Financial Cold War, and a financial advisor here in Hong Kong, who used to work at Hong Kong Exchange, HKEX. And then we have Jennifer Zhu Scott, who's executive chairman of the Commons Project Foundation. You can find more information about all our panelists on the Asia Global Dialogue website. But let's go right in. Now, just to remind, may I ask listeners and viewers to post their questions in the Q&A box, and we'll get to them either during the conversation or towards the end. But let's do a tour of the table, as it were, and see what our panelists think. So Jen, let's start with you. Could you tell us how you see the deglobalization, decoupling narrative, particularly in the areas that you are closely following, technology and data, public health, and climate?
Thank you, Al. Great to be in the presence of such an impressive panel, fellow panelists. Good morning, good evening. I think let's go back just slightly about in the 90s. I'm on the board of the Web Science Trust, and that's founded by Tim Berners-Lee. In the 90s, when internet was first invented, it was really about transcend the national borders, democratizing information. But today, we forget about what's happening between US and China. There are actually about more than 60 governments around the world drafting or initializing more than 150 data localization regulation. And we also see in the past few years, because of this unfortunate tech code war between China and US, in terms of tech localization, reorganizing supply chain, companies and investors have to not only just have two sets of strategy, for U.S. friendly markets and China friendly markets. We're also seeing increasingly these areas that traditionally that was safe for the two countries to exchange ideas and collaborations have become politically very sensitive as well. Now, I spent last 2.5 years, almost 3 years, as the chairman of the Commons Project, because we just came out of this global pandemic. You couldn't get one more global shared challenges than a global pandemic. Our work was very much focused on creating global immunization data standards, creating immunization and testing data interoperability between different countries. We co-developed immunization data standard called Smart Health Cards with Microsoft. But because we're nonprofit, we try to stay neutral, and we managed to get Canada, Japan, multiple countries in Africa, Singapore for incoming travelers from the US, and also for Google and Apple for the first time, and iOS and Android adopted the same data standard. So it was possible for us to do some work that actually transcends national borders, geopolitics, and operating system. Now, I just came back from Singapore after attending the Bloomberg's New Economy Forum. And the day before the forum, President Xi and President Biden just had a meeting in G20. I think he actually exceeded my expectation in terms of how positive the framework was. I'm going to quote what Henry Kissinger spoken at the conference. What he said was last year he thinks we are at the precipice of U.S.-China Cold War. So now there is a possibility with this new framework to build a bridge. So if there is no substance in terms of tangible policies, substantial business collaborations, then we will go back to Cold War again. So I think right now is actually at this very moment is the opportunity for the two countries as the two largest economies to lead, focus on the areas that's problems shared by the entire world, such as climate change, such as Russian-Ukraine war, and come up with some positive outcomes as a new chapter for the two countries, and de-accelerate this downward spiral of geopolitical tension. Thank you all.
I think you're on mute, Al.
Yeah, I just realized that. Thank you very much. Thank you very much, Jen. Let's move on. So, James, the debate over the merits of globalization have most often revolved around trade. Trade flows, however, only account for around 10% of cross-border capital flows, but financial flows account for around 90%. So arguably, we need to understand the dynamics of the financial system. So how do you see things in terms of the deglobalization, decoupling narrative?
Well, first of all, I'd like to thank the Asia Global Institute for hosting this event and for inviting me to speak. I spent almost 10 years of my life at Hong Kong Exchange working on the internationalization of China's financial markets. So I'd like to provide a little bit of perspective on this aspect of globalization. And since we're talking about the debunking of this deglobalization theme, I'd like to talk a little bit about some somewhat overlooked factors in the debate right now. Why is the debate over sort of deglobalization even started? Well, fundamentally, this is an issue of people being unhappy with the system. And as Victor Fung talked about in his opening remarks to the previous panel, rising levels of inequality are leading to popular dissatisfaction and the rise of populism around the world. So what we have here is an issue over the distribution of resources. And what's responsible for the distribution of resources? Well, this is what financial markets were invented for. And it is fiscal policy, it's monetary policy, it's the incentive structures, the financial incentive structures within the system that very much drive the allocation of resources and the inequitable distribution that we've seen arise, that has led to so many social and political tensions in many countries. Let's be clear. I mean, globalization of trade has actually driven massive efficiencies, and it's increased the aggregate productivity around the world, which has, on average, significantly raised humanity's overall standard of living. So the idea of deglobalization in trade, i.e. shrinking the pie in amongst a situation where people are politically unhappy or socially unhappy because they don't feel that they have adequate amounts to live on, adequate share of the spoils, that seems to be something that's very much likely to worsen the social and political tensions that we've got. Now, another factor or another argument that often is now raised in the course of the deglobalization debate is one around security. Now, we must acknowledge that there have been significant failures in globalization, and highlighted most aptly by the COVID-19 pandemic, we saw systematic failures in risk management of global supply chains by multinational corporations. And clearly that's something that needs to be addressed. We need greater levels of redundancy. We need greater levels of buffers in there. But that's not something which argues in favor of deglobalization or decoupling per se. The other factor around security is obvious. The other factor around security, obviously, particularly surrounding the geopolitical tensions that have arisen, is the issue over financial security and the trend towards increasing weaponization of the international financial system against strategic rivals by major actors within the system. I would argue that the weaponization of the global financial system is a very dangerous thing, because it has it's not really actually achieved the objective of avoiding the escalation of tensions. In fact, it's done quite the reverse. It's served to undermine security even further. And because of the butterfly effects of financial markets, that the use of the financial system or the weaponization of the financial system is something that is inherently unpredictable. The second and third order effects of the weaponization of the system through sanctions, trade wars, etc., can lead to significant unintended consequences. And many of the costs of those often fall on those innocent bystanders who are least able to cope with these types of problems. So I'll end my comments by saying that when we talk about this deglobalization debate, we really actually need to look at what problems we are actually seeking to address. And I would argue that we now have an urgent need to look at the problems, the imbalances that have been driven by the structure of the global financial system, and particularly the US dollar-centric global monetary system, and national financial policies such as tax, such as competition policies, and so forth, which have contributed to rising inequality. And further, with regards to the weaponization of the international financial system, I would say that actually this is something that we need to be very careful about. And in fact, we need to find a way to provide a safe passage for all travelers on the global financial highways if we are to restore trust and security within the international system. Thank you.
Thank you very much, James. Now, Andrés, in June this year, you wrote a piece titled Fact-Checking the Deglobalization Narrative. And if I might quote, because you cheekily, if I put it that way, wrote, if governments get it right, a more subdued, but also more sustainable and longer-lasting kind of globalization will emerge. And in an open and growing world economy, peddlers of deglobalization theories will find it easier to change jobs and reskill. I'm wondering if you could tell us a bit about your argument and your views on the deglobalization narrative.
Thank you very much, Alejandro. Great to see you. I was never a great football player. I have to fact check you on that. Very enthusiastic, but not very talented. And I am honored and delighted to be joining this very distinguished panel. Thanks to the Asia Global Institute, to its chair, Victor Fang, and to the staff who put together this wonderful conference. I'm an economist, so I'm going to begin by talking about trade in goods and trade in services. I do not think globalization is going anywhere if we define it as trade. And the reason is politics. Once upon a time, I was a public servant and a politician and a minister in my own country, Chile. And Chile is a very open economy, and we sometimes worried about the politics of trade liberalization. So we ran a lot of polls. And I still remember the results of the following poll. If you ask people the following question, should government be in the business of helping local companies so that they will create more jobs? 80% of people say, yes, of course, help local companies, protect local companies, do what it takes to help them create more jobs. Then the next question in the poll was, do you think governments should engage in protectionist policies that would raise the cost of goods at the local supermarket? And 80% of people said, no, 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 don't do that. I like my goods cheap. I like my inexpensive trainers from China. I like my vegetables from around the world. I like my good Chilean wine if you happen to be in Europe. Bottom line, as James correctly said, trade in goods has raised the living standards of billions of people around the world. In some complicated ways that have to do with the flow of technology, with the reallocation of resources, but also in very simple and trivial ways. We go to the shop, we go to the local supermarket, we go to the local shopping mall across the world, and a pair of blue jeans or a pair of running shoes today cost a third or a quarter of, or even a tenth of what they cost a generation ago. And that is, of course, the result of trade in goods. And because most countries, not every country, respond, the governments respond to public opinion. If public opinion wants inexpensive goods is what they will get. I do not think trade in goods will be radically changed. It will be changed in some ways, and those are the ways that I mentioned in my article. I think the pandemic revealed that it is probably unwise to have one supplier per company, especially if that supplier is across the world. So companies will diversify their suppliers. If this is what is meant by nearshoring, I don't equate it with protectionism. I think it's simple, prudent management of supply lines. You don't want to have one. You probably want to have 3 or 4 suppliers. You don't want them all to be across the world. Maybe 1 or 2 should be in the country next door, or even if in your own country. But in no way is that tantamount to a return to protectionism. The second point I want to make is that, of course, not all trade is trade in goods. The other big chunk of trade is trade in services. And I am willing to take a stance here. I could be eating my own words in a few months or years and assert that trade in services is going to expand at a very rapid clip for the simple reason that technology makes it much, much easier. Think of what we're doing right now. The 5 of us are having a dialogue. Presumably, we are providing some value to someone. We are engaging in commerce of ideas and commerce of proposals and policy innovations. And some of us are in Asia, some of us are in Europe, some of us are in America, and we're doing it without leaving our homes or our offices. The potential for trade in services in this domain is gigantic. As a Latin American, I think, what are we going to do with the many people who went to university over the last generation and can't find jobs? You take a taxi in many Latin American cities, it's quite likely that the taxi driver will have a university degree. Well, those recent college graduates who cannot find jobs at home are finding jobs abroad, because a Brazilian engineer can participate in the design of a project in Asia, or a Colombian architect can help design social housing in Berlin. You may need a partner to get over the permitting requirements, but the fact is that today it is much, much easier to sell services across the globe. I am aware that services are a highly regulated sector. If we're talking about transport, financial services, of course, regulation is the name of the game. That regulation is not going to go away overnight. But the basic fact remains that when it's easier to do something, when it's cheaper to do something, the impetus is in favor of the expansion of that service. And I'm pretty sure that's exactly what we're going to get. So that's, I think, strike 2 in favor of what we call globalization. Having said that, I have points 3 and 4, and they are caveats, or they refer to other kinds of globalization where I think the trend is in the opposite direction. James spoke with great enthusiasm about the liberalization and globalization of capital flows. I do not think complete capital mobility is a great asset in the world economy. I do not think it has brought unambiguous gains to people across the world. On the contrary, there's plenty of academic empirical evidence that suggests that, of course, capital flows are necessary. We want to be able to borrow from abroad at times of need and maybe repay when times are good. However, every last bit of short-term portfolio reallocations, every last bit of short-term speculative capital is not necessarily good. That is one thing we have again and again learned over the many financial crises the world has endured in the past quarter century, including the gigantic world financial crisis of a little over a decade ago. So I think it is perfectly imaginable that we will have a world in which trade in goods will change but will not go away, in which trade in services will flourish, but trade in capital flows will face new restrictions and new controls. Of course, it depends what the restriction and what the control is. You can think of good ones, you can think of bad ones, but the idea that capital flows ought to be regulated in a more systematic manner than they have been in the past, at least to me, that does not strike me as a bad idea. It is probably a good thing. Last but not least, I'm not sure you can call political integration globalization, but let's do it. Where the real problem is, in my view, is simply in politics. That Clinton advisor used to repeat that it's the economy stupid. When I wake up at 3 a.m., I worry that the real problem in the world today is that, it's the politics stupid. I do fear, and I think there's gathering evidence of a split in the world between autocratic regimes and democratic regimes. And let me underline that this, in my mind at least, is not synonymous with a US-China split. What we're seeing today across the world is a resurgence of either illiberal democracies or simply illiberal regimes. And these are not necessarily in the East. If I look at the Americas, certainly American democracy has been shaken by the emergence of Trump and by the turn by the Republican Party into a party with occasionally undemocratic attitudes. If I look at Latin America, which is a country that a continent that endured in lots of democratization over the last 25 years, this democratic backsliding in Venezuela, in Nicaragua, in El Salvador. A man in Brazil was just defeated who was not exactly a stellar Democrat. And of course, if you look at, say, Eastern Europe, some of the poster children for transition to democracy, I'm thinking of Poland, I'm thinking of Hungary here, have slid back into something that looks like quasi-authoritarianism. And you can think of other examples around the world in which democracies are under some strain. Turkey is one country, India is another country, the Philippines is another country. So yes, are we going to have an enduring fight, a test, growing tensions between Democrats and authoritarian types across the world? Yes, but this is a lot more than the US-China split. Let me leave it at that. Thank you very much.
Thank you very much, Andrés. That's insightful. Fred, you've been a key figure in analyzing and observing regionalization, globalization efforts for years, particularly focusing on trade initiatives and their impact. And as I mentioned, you chaired the Eminent Persons Group of APEC from 93 to 95. And you now have a new book, which really does practically, it's called The United States versus China, the Quest for Global Economic Leadership. And you deal with this decoupling issue, and you actually provide a kind of framework for addressing it. So, Fred, over to you.
Thanks very much. It's a great pleasure to be here with your Asia Global Institute, and especially to hook up again with my old friend Victor Fung. Victor was a very distinguished and critical member of that APEC Eminent Persons Group from long ago, which actually got the ball rolling for Asia-Pacific trade integration that eventually led to the Trans-Pacific Partnership, the RCEP that's now gone into effect. And so we feel that we're kind of godfathers of some of the integration process that has occurred in the region over this last generation. And as James was saying, to the huge benefit of billions, literally billions of people in the region. As we address deglobalization, and I agree with Andrés, it's largely a myth, but one has to distinguish different pieces of it. The most direct policy step that has contributed to deglobalization in the last few years is the trade war between the United States and China. That has cut back trade, technology flows, even trade in services that Andrés focused on, and threatened to reverse some of the very healthy globalization trends that we had seen in the previous decade. Therefore, along with Jen in her opening comments, I was very encouraged by the meeting earlier this week between President Biden and President Xi Jinping. She quoted my old boss, Henry Kissinger, as saying that this provided an opportunity to get things back on track between the two countries, which in turn is critical for the world economy and the globalization process, because these are the world's two economic superpowers, the biggest economic powers in the world. And as they go, although they're not the full story in terms of the political conflict, as Andrés said, they are the biggest economies, and they very much set the tone for where the world economy is going. So I was very encouraged that the two leaders in Bali earlier this week did agree to start cooperating in areas where their interests coalesced, and immediately started getting back together to deal with global warming, which was the one specific issue that they mentioned. Now, their agreement was a broad one, a rather vague one, no details except to say that they would start talking to each other again, which is critically important, on global warming. But nevertheless, it seemed to open up the door for new cooperation between the two economic superpowers, which is critical for the world economy. It's critical for a whole range of issues, dealing effectively with pandemics in the future, getting the world trading system back on course, as I said, by rolling back the trade war between them, global macro coordination, cooperation, as in dealing with the global financial crisis over a decade ago. All those things can now only occur successfully and effectively if there is cooperation between the United States and China. So the critical issue, it seems to me, is whether the two countries can get together and work cooperatively despite the sharp differences between them on a lot of security, values, and political issues. Now, to put another sort of hopeful note in this, there are several instances in the last few months, some below the radar, where the U.S. and China have cooperated on economic issues. Back early this summer, at the Ministerial Conference of the World Trade Organization, the United States and China sat down and worked out a resolution of the thorny problem of how to deviate from the intellectual property rules to permit more COVID vaccination investment. That U.S.-China agreement rescued the Ministerial Conference of the WTO, enabled it to come out positively and give at least a modest boost to the global trading system. And that was cooperative and constructive global leadership, cooperatively between the U.S. and China. Just a few weeks ago, China and the U.S. reached an agreement on some very technical issues concerning corporate registration, accounting, regulation, which permitted the continued trading of Chinese corporate securities in the U.S. financial markets. Again, they were able to get together. So I have some positive feelings that with the new agreement from Bali, top-down guidance to the two governments to start cooperating, at least in economic issues, there is some hope. The problem is that so far, all this cooperation that I've mentioned has been very ad hoc. It's been reversible. It's been volatile. It's been up and down. And so it has not been consistent in the way that is needed to provide global economic leadership of the nature that is required. Therefore, what I would suggest is that the United States and China agree in principle and as a policy guideline to pursue what I call functional decoupling. The United States and China are going to continue to disagree on a lot of security issues, the South China Sea, Taiwan, other topics. They're going to disagree on values issues, the treatment of Hong Kong, the Uyghurs, etc. But at the same time, I believe they can and demonstrably have worked together on economic issues. So what I call functional decoupling would indicate that they agree explicitly to work together in the economic sphere, provide the kind of joint global economic leadership that is now required, since China is the rough equivalent of the US in global economic power terms, even while they disagree on the political and security issues. Now, one, of course, immediately faces the question, what is an economic issue as opposed to a security issue? And we know that there's tremendous overlap. There are lots of dual-use products. We know that lots of, quote, economic topics have important security implications. So one thing the United States and China would have to do is sit down and talk about that and try to figure out where the boundary lies. What is security? What is economic? Where would their agreement in principle that I'm postulating to agree and work together on economic issues, where would that pick up and where would the security differences leave off? That's difficult. It would not be resolvable in one go. They'd have to set up some procedures to talk about it in an ongoing way. But I think that would be healthy as an instance of the kind of cooperative global economic leadership that I think is going to be essential for the United States and China to work out and pursue if the global economy is to succeed, and if the trend toward Cold War between the United States and China is to be at least blunted, hopefully headed off, and certainly not exacerbated by further economic problems. Final point, all this that I'm suggesting right now does fit into the broader context of the need for broader global economic leadership than we've had in the past. The United States, with its traditional allies in Europe and Canada, Australia, and elsewhere, has provided the kind of leadership that enabled the global economic order over the past 75 years to generate the huge benefits that James and Andres both talked about. The United States no longer can do that alone, partly because of some internal political slippage here in the United States, but also because the rise of China provides the first real challenger to the United States for global economic leadership since the US became the world's supreme economy over a century ago. So you've got a new structural situation. It's going to require cooperation, not confrontation. Fortunately, the Biden foreign policy construct permits that. President Biden and his team have said, even before they took office, certainly since they've been in office, that they view US-China relations as occurring within several different baskets. There will be a confrontation basket. There will be a very widespread competition basket. But there also can be and should be a cooperation basket. My suggestion is that the countries agree to put the economic domain in that cooperation basket, use it to both improve their overall relationship, but most fundamentally, use it to re-strengthen the global economy, deal with the backlash to globalization, keep the trends going in the right directions that Andres laid out so nicely, and make that a central focus for both global economic policy and US-China relations going forward. Thank you very much.
Thank you very much, Fred. Appreciate that very much. Jen, if I could come back to you and focus on data, because we hear now it's a common, almost a cliche to say data is the new gold, as it were. But there's so many efforts around the world to come up with standards for privacy, security. Europe has their own, and those who visit Europe will see the effects of that every time you go on a website with the requests about cookies and all that kind of thing. And then you have the United States doing its own thing, but then of course the United States and Europe trying to come up with their own. And there are other efforts around the world. There's a interesting data initiative involving Chile with Singapore and New Zealand. I'm wondering how you see that particular issue sector developing in terms of, can we achieve any kind of global standards, or are we going to have this divided data world with different standards for different places?
Yeah, thank you, Al. The short answer is it's completely possible. It's not a technical challenge, it's a political challenge. Coming back to Fred's comments, I think what Fred proposed is very constructive. But however, I think we need to throw a few curveballs. It's just the reality into the mix. Number one is that if U.S. continue to define its interest as maintaining the dominance forever, it will become, China's rise naturally will become a conflict to the U.S. Number two, I think the new leadership in China, nobody have seen truly what it is about. We have seen glimpses of indications, and there are a ton of speculations, but I don't think anybody can say for sure. One thing we can be assured is that because China doesn't have democracy, leaders are not elected, so the legitimacy of the leader comes with the people will buy in terms of what's being delivered, at least to a threshold that does not cause any of the public conflict. So the third curveball is also, I think, what President Biden has laid out and his team laid out in the recent weeks are much more encouraging than the first part of his presidency. However, we also know the U.S. leaders will change, a different party. Now the midterms finished, President Biden's control of the House has been taken back by the Republicans. So there will be some, complications. And 2024 is not foregone conclusion. So a lot of those curveballs that's still in the mix in terms of how do we reconcile that the two countries need to seek the common grounds while embracing each other's difference. At the same time, it's just the reality that China has 1.4 billion people and they deserve a place in the humanity, even if their rise and growth probably does not fit into neatly in a lot of Western lens. Secondly, also in terms of on the technology side, where I've spent all my time on, for example, even if the two countries working on climate change and sustainability, those kind of less political issues, we still have policies such as CHIP Act forbidding that collaboration on those very sensitive areas. So the reality in China is that every year there are millions, 4 times of number of engineering students graduate from Chinese universities. It's the world's largest market. It's the largest trade partner with more than 120 countries in the world. It has all the capitals and all the incentives, and also it's the largest market. Even if there are certain areas, because of those limitations and policies, restrictions, probably will slow down China's development in some sensitive technology sectors, but it's just a matter of time. Even not with every aspect, China will catch up. So those are the realities that I think while we seek the common grounds and embrace the difference and identify confrontations, we need to throw them into the mix. Coming back to what you asked about in terms of the data, I actually think, in the spirit of seeking common grounds, I actually think despite the ideological differences, political differences between US and China, a lot of societal challenges we share in common is this the reality of the world has arrived at the inflection point between digital economy 1.0 to what I call digital economy 2.0. Digital economy 1.0 largely was in a very centralized structure with a winner takes all type of business model. And we left with a handful of companies, both in the US and China, have a monopoly, duopoly kind of situation. In those situations, not only just in terms of social media causing tremendous societal-wide mental health challenges in terms of making the society much more polarized than it should be. It also really creates this very fundamental problem that in this digital economy 1.0, especially with the tremendous empowerment from technologies like AI, that will create a very large gap between those have and have-nots. And if we think that in the past 50 years, the have and have-nots in the traditional analog economy was extreme, and just wait and see when the very few on the top will be able to control some of the most powerful technologies. So the challenge both countries and both systems are facing is actually this control of data ownership. So in a very centralized first generation digital economy, we are seeing large companies, they collect and control individuals' data. Today we have 90% of the data, or more than 90% of the data floating around the world are generated by individuals. And yet this data being controlled by handful of companies mostly between US and China. And this kind of centralized control apart from social, mental health issues, political issues, challenges to democracy, freedom of speech, etc., we actually also have these economic challenges in the digital economy. So I made a proposal in 2019 in terms of allow individual to get paid for the data. Largely is driven by this, my frustration of watching this discourse in terms of dealing with the centralized digital economy, that in Europe, the response is mostly coming from regulation. So we see GDPR, that's very useful to set as a floor. However, for something as nuanced as privacy, what's private to you is very different compared to what's private to me. What's private to me today as a professional and a mother, very different compared to what's private to me when I was in college. So for something as nuanced as privacy, it should not be completely rely on regulations like GDPR. In the US, most of the reaction to those challenges is really coming from antitrust approach, and which is also limited because you break one company into two or break two companies into four, the fundamental problems still remain. In China, we are seeing a mixed bag of very confusing suite of policies coming out, really cracking down the first generation of this digital economy, where the type of a digital platform that simply bundle hundreds of millions of people with a smartphone and to organize their daily activities, they just simply no longer regarded as an innovative company anymore. And the support have shifted to deep tech, such as quantum computing, genome, space tech, new material, new energy, etc. So what we need at this point, in my view, is actually a fundamental shift to a more decentralized digital economy, what I call digital economy 2.0. Now, when I say decentralized, with everything happened in the past week or two, FTX drama, probably people feel very allergic to this word. But what I mean by decentralized is actually fundamental in online infrastructure, digital infrastructure that empower the individual. To allow individuals to not only just control and access their own data, but also the economic value of those individuals' data will be able to realize. Now, I think in my view, if we debunk deglobalization, because this is a challenge faced by all countries, by all governments, and really has nothing to do with their political system or ideology. This is something we are facing at the same time. So have this new approach in terms of how we organize digital economy, and potentially even use this economic value of individuals' data as a foundation for universal basic income in a very AI-driven economy. That could become a new initiative that collaborates in between countries, regardless what's their political beliefs or governance system. I have a glimpse of hope, and I think we're seeing some of the new initiatives, a lot of solutions that have been presented in the market now that really accentuate and empower individuals' data ownership. I think if we can realize that pillar, we might have some new opportunity to create a more sensible, inclusive AI economy, digital economy, and that's globalized.
Great. Thank you very much, Jen. Now, James, if I could come back to you to focus on the global imbalances that you were referring to, particularly in the dollar-based global financial system. I mean, the dollar-based, so it brings to mind this issue about the dollar and the dominance of the dollar. And again, another area where there's talk of decoupling, that China in particular has been trying to internationalize the renminbi, at least moving towards that, to conduct transactions in renminbi, so avoid the costs related to doing transactions in dollar. I'm wondering if you could talk a bit about those imbalances and where we are in terms of that kind of competition, if you will, between the currencies, or the issue of the dollar dominance, if I can put it that way, and where it's going.
Well, the question of the dollar is really two-sided, because the globalization in trade that has been enabled by having a common unit of transaction, which the dollar has been since the end of the Second World War, it's really the dollar has been one of the fundamental pillars that's allowed globalization to happen and all the benefits that it's brought with it. But the problem with the dollar is that it is not just the world's currency, it's also America's currency. And when you look at the consequences of the dollar serving in that global utility role for the United States, it is not an unmitigated good by any means. Sure, I mean, a lot of people in the United States have benefited hugely from the role that the dollar's played, particularly over the last 40 years. If you've been the shareholder of a large US corporation that's been able to take advantage of a structurally overvalued dollar in pursuing your globalization of your supply chain. And the dollar has been structurally overvalued because of the international demand for dollars in global trade and, crucially, financial investment. If you've been in that position, you've done very well. But for many US workers, the structural overvaluation of the dollar has exacerbated the loss of export competitiveness and accelerated the trend of deindustrialization in the US, which has contributed to many job losses and stagnant wages in real terms for a lot of American workers. And so I would argue that the dollar, rather than being, as one former French finance minister described it, an exorbitant privilege for the United States, the reality is that the most people in America probably would be better off if the dollar did not serve in that role. The other issue of the dollar is that as we've seen with the recent following Russia's invasion of Ukraine and the international response to that in terms of financial sanctions, that has been something which has, I think, significantly undermined the dollar itself as a global unit of transaction. What you're now seeing is many countries in South Asia, in the Middle East, transacting with Russian counterparties are now having to transact in a different currency, and some of them have been using the renminbi. China itself, with $3 trillion, or at least at the end of last year, $3 trillion of foreign exchange reserves, the possibility of having its foreign exchange reserves frozen in the event of a conflict or some disagreement with the US has always been a theoretical risk. But what's happened with those sanctions, the unprecedented sanctions that have been put on Russia, it's turned that theoretical risk into a real and imminent threat. Now, there are many commentators out there who kind of look at China and think that China has been, pursuing some strategy to usurp the dollar or for the renminbi to usurp the dollar as the global reserve currency. My own interaction with Chinese policymakers suggests significantly otherwise. In fact, there's a great amount of wariness on China's part about its currency serving in that global utility role, simply because they've looked at the costs of that role for the dollar to the US itself. And they've said, well, actually, we're really quite wary about this. And so there has within China's policymaking circles a push and pull over this question of renminbi internationalization. But faced with the threat that they now perceive, I think China will have to significantly accelerate the pace of renminbi internationalization and certain amounts of outbound capital flow in order to reduce its dependence on the dollar system. And I will add that, for China, this is really existential, because although we all think of China as a very large exporter, the reality is that China is a very large re-exporter. The input commodities that go into Chinese exports most often have to be imported from elsewhere. And most crucially, China is not self-sufficient for either food or energy. It has to import over 80% of its energy needs. And therefore, China has to have trade. And because of the particular development model that it's pursued, and it is absolutely true that, for a decade period between 1995 and 2005, China pegged its currency to the dollar, and then for a decade thereafter, it managed the rate of its currency in a way that favored it in terms of its trade. But the fact is that China, because of that, has significantly underdeveloped their own capital markets, and hence have left themselves, from a security point of view now, excessively dependent on the dollar. And so when you talk about, changing or shifting the imbalances and addressing the imbalances, I think what we have now is a set of circumstances which will force China to internationalize its currency to a much greater extent than it has been previously willing to do. I'm not saying that it's going to open up its capital account entirely in the US sense, but the greater internationalization of China's capital markets in certain ways, and certainly the mobilization of China's household savings for pension savings needs in international markets, I think could have very many beneficial effects. Firstly, by taking some pressure off the dollar and the imbalances that has generated. But secondly, also, and I certainly agree with Andres's comments earlier on about the dangers of speculative capital flows. But I think that there are underemployed or underdeployed savings in China which need to be deployed for very real economic needs of China's retirement savings and generating appropriate yield and return on those, and where that capital, if deployed internationally into infrastructure, R&D, and other development, could have very beneficial effects.
Thank you very much. Andres, I'm wondering whether you had any comments on what James has talked about, but also I really like your, it's the politics stupid. I actually think it should be, it's the stupid politics. But one of the issues, and you write about this in your article, in your piece about supply chains. If you look at things, think of things as non-political, as it were, as protective, personal protective equipment, masks, vaccines, even semiconductors. But even though they do have a national security dimension, it just does seem that the supply chain reconfigurations are creating what seems like a deglobalization world, like a bifurcating world, or like especially the idea of friendshoring, I think has become quite fashionable. And so I'm wondering if you could also address that. Any other comments you might have on the discussion? Cheers. Yeah.
There we go. Happy to do as you say, Alejandro. And let me begin with the comments that James made on the role of the RMB, the role of the dollar, reserve currencies, et al. The world doesn't have a lot of reserve currencies. It's basically the dollar, to a much lesser extent the euro, and that's about it. The British pound used to play that role, it no longer does. The Swiss franc kind of gets near there, but not quite, nor does the yen. To be a reserve currency, you need two things. The first thing you need is to be the currency of a country with very strong institutions, so that people wish to hold your currency. And the second thing you need is for that currency to be convertible, so that I can get rid of it whenever I want. At the risk of sounding a little extreme, I'd say that the renminbi today does not meet either standard. That is to say, it is not the currency of a country whose institutions are comparable to those of the world's major democracies in terms of transparency and predictability. And secondly, it is not a fully convertible currency. I am not free to buy it and sell it at will, in any place, at any time, at whichever price the market will fetch. And as a result, it is hard to envision that currency becoming the world reserve currency, or a world reserve currency, anytime soon. In addition, reserve currencies and currencies of massive invoicing are also what they are because of big network effects. Companies set their prices in dollars because buyers understand what dollars is, because other companies are setting their prices in dollars, and because it's easier to have the same currency for pricing as everybody else in your market, so that the buyers can tell them apart, shop, compare, and decide whose stuff to buy. And therefore, the biggest argument, aside from the institutions and the convertibility, in favor of a dollar standard and the dollar remaining a world reserve currency is that a lot of other people are using it. They're using it for invoicing and trade, and they're using it as the reserve currency, in the basements of their central banks. And again, it is hard to envision a situation in which that equilibrium becomes dislodged and simply is undone overnight. Could it happen over a century? Maybe it could, but I simply don't think that we have enough information to forecast 5 years ahead, much less 50 or 100 years ahead. So I don't know. But with the info that we have today, with the configuration of financial markets that we have today, with the relative weight and quality of institutions across countries, I think the dollar remains unchallenged. And let me say one last thing about the dollar. The old joke is that an emerging currency is one you cannot emerge from during an emergency. Well, the opposite of an emerging currency is one to which you run, where you seek refuge at times of emergencies. And we have seen again and again and again during the world financial crisis of 12 years ago, during COVID, now during the Russian invasion of Ukraine, that whenever there's a big tremor in the world economy, people simply run to the dollar. And the dollar is extremely strong today. Pretty much every other currency around the world, including the pound of the country where I live, have all been weakening and weakening and weakening against the dollar. So, some people may like it, some people may not, but I don't think King Dollar is going to be seriously challenged anytime soon. Regarding the structure of supply chains and supply lines, yes, I think we're beginning to see a change in configuration. As I mentioned in my initial set of remarks, it is likely that the sort of hyper-globalization in which a firm based in Arkansas had only one supplier based in China, and that was sort of the kind of, it takes two to tango relationship, that will change. Now, will it change because of political considerations, or will it change simply because of safety and prudence considerations? You can tell the story both ways, and it's probably more appealing. You get more headlines if you tell it in terms of politics and you call it friendshoring. But I think there's simply an element of efficient management of risks. I think a lot of companies realize that they were too exposed, that the world is a shaky place, that there are all kinds of, we used to think of financial risks, but we've learned that there are health risks and that there are political risks and there are a bunch of other risks. And as a result, being more diversified in terms of who supplies your stuff is not necessarily a bad idea. The other thing that I'd say, and I'll end here, is that even if supply chains come closer to home, that doesn't mean that they all come within your national borders. So if I think of, say, the Western Hemisphere, yes, it is possible that some input suppliers that might have been in Vietnam or in China could be in Mexico or in Colombia, but Mexico and Colombia, last time I checked, were not the 51st and 52nd states of the United States, meaning you will still have international trade. And maybe within a region, within a continent, the shape and form of that international trade may change. But I don't see every last supplier of every large American company, relocating to Arkansas. That simply ain't going to happen. And the last thing I'd say is that these are mostly, unless national security is involved, these are mostly the sovereign decisions of companies. So, governments may have whatever political views they have, but unless there's a national security directive that allows the government to say, don't trade with that country, companies will do it only insofar as it is profitable or convenient. And therefore, I think there are natural bounds on how much deglobalization you're going to get, because it remains profitable and convenient to have suppliers elsewhere in the world. Maybe across the world in China, if you're a US-based company, maybe a little bit closer to home in a place like Mexico or Colombia or the Caribbean or Brazil, but some degree of internalization of supply chains, again, is not going to go away anytime soon.
Thank you, Andrés. Jen, before I go back to Fred, Jen, you wanted to say something quickly about the digital remedy.
Very quickly. Broadly, I think in terms of the traditional finance point of view, I completely agree with Andrea's assessment in terms of the keen dollar will not be challenged. But the wild card here is digital RMB is ready to be launched. And one of the functions with digital RMB is direct remittance, which means it will bypass SWIFT. And given that China is very active giving loans and aids in Belt and Road, have active trade in multiple countries, and to have millions of tourists traveling overseas once the borders open, I think that will throw a very different mix of calculation in terms of if the dollar will be challenged or if there will be dollar still remain as the reserve currency, but each RMB created its own alternative ecosystem.
First, and then Andres. Just very quickly, because we would like to move on here. James.
Okay. Look, I agree that with Jennifer that the innovation of central bank digital currencies, and particularly the ECNY, will be significant, but not necessarily because it allows settlement flows to bypass the SWIFT network. I think the major, and so Andres was absolutely right that people don't want to hold renminbi as a reserve asset right now because of certain institutional concerns about the sovereign. But if you look at one of the sort of major inhibitors to internationalizing renminbi in trade, it's simply because there aren't actually available the renminbi securities in the offshore market for international holders to invest in. So if when you've got the renminbi in your hands, you can't invest that into something productive. You're going to demand payment in dollars or euros or other currencies. So the significance of the digital renminbi, I think, is that there are two major reasons why, in order to get the offshore system going, China needs to let more renminbi out. The two major inhibitors to that are, one, the security risk. Any Chinese investor investing outside of mainland China beyond Hong Kong today is entirely dependent on a Western-controlled financial infrastructure, and therefore there are sanctions and other security concerns. Second, it comes down to much more mundane factors, which is that unlike the United States, China is unable to impose FATCA on the rest of the world. And so when you allow Chinese citizens to come and bring their money out and invest in international markets, that is accompanied by a risk of fiscal leakage from tax avoidance or evasion by their own citizens. When you have an offshore renminbi ecosystem of investment products and underpinned by an ECNY, where it's transparent to China's central bank what their citizens are investing in and holding in the rest of the world, then you actually enable Chinese capital internationalization to move to the next step. And there, I think that's where the significance of the ECNY comes in. It's an enabling tool to allow China not to bypass other infrastructures. I think the infrastructures actually have yet to be built, but it will allow greater transparency of the outbound flows of China's own citizens.
Thank you very much. Very quickly, Andres, you wanted to say something?
I will be hugely brief. I think Jen is absolutely right. China is way ahead of the US when it comes to issuing a digital currency, and it will make a difference. The question is, what will it make a difference for? Will it ease the life of people who want to pay for a hotel room in East Asia if they can simply draw on their account at the People's Bank of China? Yes, of course. will it change the calculus of an asset manager sitting in Sao Paulo, Brazil, or the central bank of Brazil, or the central bank any place in the world that wants to have some assets that they can draw upon safely in times of crisis? Not at all. So as a means of exchange, yes, it makes a difference. As a reserve currency, very little difference, as far as I can say.
Thank you. Now, Fred, you wrote quite extensively about the G2, which is, in fact, you are the progenitor of the idea, the concept of the G2 in 2005. So in some ways, what you've already talked about, a G2, even if it's kind of not quite, not officially announced, it could be an important approach to addressing this decoupling narrative. So we're at the end, but we have time. So Fred, no real time limit, but talk a bit about the G2 and what you see as a particular solution to the decoupling that we're seeing, particularly in the context of U.S.-China.
Well, I think the United States and China actually did pursue the G2 idea toward the end of the Bush administration and the first year or so of the Obama administration. And it ran aground for various reasons having to do with the global financial crisis and China's reaction to that. But when I called for a G2 then, and you're right, implicitly now, it is not, to repeat, not by any means to imply that the roles of other countries, the Europeans, Japan, Canada, etc., it's not to imply that those countries are not important or that they should not be involved in global economic decision making. It's simply to say, which I think is the fact now, that unless the US and China agree, at least in broad terms, it'll be very hard to make progress on any major global economic issues. As I said in my remarks, whether that's climate change or pandemic responses or reopening the trading system or avoiding trade wars and technology conflict, I think the US and China have to be in large agreement if those things are to be pursued successfully. And I labeled that a G2, and one could still call it that. But it is not intended to undermine or render useless the existing global institutions from the G7 through the IMF and the WTO. In fact, it's to make them work better, because my view is that only if China and the United States can agree will the broader institutions be able to function effectively. It's a steering committee within the steering committee, so to speak, and it simply follows the age-old maxim that those who have the power must take on the responsibility. And I think that's very important for the United States to remember, also very important for China to adopt, as it is the rising power in all this. Now, that in turn raises the question that I want to respond to that Jen raised. She, in her initial response, raised two very legitimate questions about my proposals for functional decoupling. She said, well, but the United States has got to be willing to accept that. Yes, of course, that is right. And to do that, the United States has to recognize that its revealed preference of the last few years for containing China is a big mistake and will not work. Trump tried containment, and it was a miserable failure. China was the only major country that kept growing straight through the pandemic. Its share of world trade has increased sharply, despite the trade war and bilateral cutback with the United States. China is too big, too dynamic, and it's already achieved rough equivalence with the United States. So even if its growth rate slows considerably, as it will, it'll still be 2 or 3 times that in the United States. It'll pass the US on all economic comparative metrics in the near future. And so we simply now have a structurally different global economy where collaboration with China on economic issues is essential if we are to maintain an effective global economic order. But yes, the United States has to accept that. The United States has to realize that it can no longer be the supreme economy and has to share global economic leadership. That is a difficult change in mindset for the United States. Both the Obama and Trump and now Biden administrations have resisted that notion and have regarded any step that seems to enhance China's global role as an affront to the United States. They simply have to resist that. They have to learn, understand, recognize that we're in a different world. And for the U.S. to achieve its own goal, it has to work closely and cooperatively with China. Now, that, of course, in turn, requires China to play a responsible leadership role. That means modifying some of China's policies. And there, I would also have some problems and doubts. And it goes a bit to the discussion of the international role of the renminbi. I thought James brilliantly described the international role of the dollar. Andrés equally brilliantly described why the renminbi is not likely to play an international role in the foreseeable future. I will add one further point to that. China's policies over the last 5 to 10 years have been moving in the opposite direction. They have been reducing the role of the market. They have been reverting to more central control and planning, all of which moves against internationalization of the renminbi. It actually moves against the very needed improvement in China's internal financial markets. It means even more misallocation of resources and therefore slower growth for China. And it makes it more difficult for China to play the kind of collaborative international leadership role that I'm calling for. So the bottom line is there's a big need for change in mindsets in both the United States and China. It's a Herculean task, but I spell it out because I think it's the only way to get back on track for the world economy and to get back on track for the US-China relation. Final point, if we want one dramatic way to start moving in that direction, it would be to eliminate the trade war. The trade war is crazy in the current circumstances. It's not pursuing any US objective. It's certainly not pursuing any Chinese objective. To roll back the trade war would be fully reciprocal, just as China's retaliation against Trump's tariffs were fully reciprocal. So would be a rollback of those tariffs. Nobody could charge Biden with being soft on China. Nobody could charge Xi with being soft on the United States. It would be a fully reciprocal rolling back of these crazy trade tariffs. And that would be a way to get the functional decoupling process moving in a fairly dramatic way. And it might usher in some of the changes in mindsets that we have to see.
Thank you very much, Fred. So for China, they have to abide by what I call the Spider-Man principle. With great power comes greater responsibility. And the United States should abide by the reverse Spider-Man, which is with less power comes greater responsibility. So anyway, it remains for me, because I'm way over time. I'm getting lots of hints that I should get off, but I need to thank our fantastic panel. So thank you very much, James. Thank you very much, Andres. Thank you very much, Jen, especially you're doing this from the airport, from the Hong Kong airport, where I'll be very soon. And Fred, thank you very much from Virginia. So I'm going to hand it back to Dr. Victor Fung, our chairman. So thank you very much, panel, and back to you, Victor.